A General Analytical Framework for the Analysis of Currencies and Other Commodities by Warren Mosler and Mathew Forstater. The Asian Crisis of 1997. The Asian crisis of 1997 can be analyzed in the general commodity framework presented here. What happened can be described as a dollar squeeze. In the face of declining U.S. dollar federal budget deficits, horizontal expansion in Asia continued through the first half of 1997. Agents borrowed U.S. dollars and either spent them directly on projects or used their U.S. dollars to purchase local currency to run their businesses. That meant they were short the U.S. dollar and long their local currency, which was generally invested in local enterprise. Often it was the local central bank that encouraged this type of risk-taking by setting the domestic interest rate higher than the U.S. dollar rate, and simultaneously maintaining a pegged exchange rate. While the local businessmen were borrowing U.S. dollars and exchanging them for local currency, the central bank was more than willing to accommodate them and accumulate U.S. dollar reserves. However, when the private sector turned to being net sellers of the local currency to pay their U.S. dollar obligations, the central banks were reluctant to lose their U.S. dollar reserves to support the local currency, and instead let it float downward. At the lower foreign exchange rates, the local businesses were unable to meet their U.S. dollar obligations, and a liquidity crisis, which is still not resolved, followed. Continuing with our commodity framework, it was similar to being short corn while the warehouse stocks were declining. Now, with depressed local currencies, many of these countries are running sizable U.S. dollar trade surpluses. That means someone else is running U.S. dollar deficits, as the horizontal component between nations always nets to zero. As long as U.S. fiscal balance remains as it is, there is little that can be done to alleviate the worldwide U.S. dollar squeeze, except a decrease in the net desire to save U.S. dollar-denominated assets. Falling prices may decrease the net desire to save, including the additional spending. But it is not common for this to happen. In fact, it is hard to find a sector of the U.S. economy that can continue to increase its indebtedness sufficiently to extend U.S. GDP growth. The two large growth areas were the expansion of subprime and Asian credit, both of which are slowing dramatically. Furthermore, it seems all nations are pushing fiscal deficit reduction at the same time, taking away the possibility of export-led expansions. I have yet to read any mention of U.S. fiscal policy as a cause for concern and a contributing culprit in the Asian crisis. No one seems to recognize the importance of deficits in the same way they recognize the importance of the size of the stocks of other commodities. That may be why markets don't react in anticipation of the inevitable short squeeze, as none of the market participants are aware of the connection. Therefore, only after the shortage is acute does the market finally react, as shorts have no choice but to cover their positions by selling other assets to obtain needed U.S. dollars. So it hits hard and fast. Note that the Japanese economy expanded rapidly enough in the late 1980s to drive the budget into surplus. Soon after, the stock market and real estate market crashed as agents were forced to sell these assets to obtain needed yen. 8 years later, the stock market is still more than 60% off its highs, and real estate continues to drop at double-digit rates annually, in spite of years of near 0% interest rates. A yen short squeeze can only be resolved in the vertical component, and long-term budget targets conflict with that necessity.